Hello and welcome to Business Arena on TVP World. I'm your host, Marie Caso. Join me for the latest business headlines of the day. The Naftoport oil terminal in Gdańsk nearly hit the 40 million ton mark in crude and liquid fuel throughput last year, with close to 500 tankers serviced. That's a 6% increase in volume and a 4% bump in the number of ships compared to the previous season, which was also record-breaking.
Nearly 500 of these docked in Gdańsk Naftoport last year. This growth is part of Poland's strategy to diversify its energy supply.
For Poland and Central Europe, shifting away from Russian oil delivered by pipeline and switching entirely to seaborne imports was necessary.
Located in Gdańsk, the Naftoport handles crude oil, refined products and chemicals, placing it at the heart of the country's energy sector. During the first half of 2024, Gdańsk found itself among the top European crude terminals, trailing only Rotterdam and Trieste. According to Italian maritime company Costa, Rotterdam handled nearly 50 million tons, Trieste nearly 19 million, and Gdańsk ranked third with almost 18 million tons.
There's been a sharp increase in oil transportation by large tankers, bringing in much bigger vessels and hence greater tonnage. Handling 489 ships demanded a huge effort on our part.
In 2021, over 60% of Poland's oil came from Russia. By 2023, Warsaw has slashed that figure significantly, turning to Saudi Arabia, which now covers about 45% of the demand, and other suppliers like Norway, the United States and Nigeria. And because pipeline imports are not coming back, Gdańsk will remain a key gateway for Poland's diverse oil supply.
The IMF has released its 2024 report on Poland, which sees a robust economy with a healthy growth forecast for the near to mid-term. In the longer term, however, they feel that some significant adjustments will need to be made.
The IMF's views do not diverge much from the consensus, with growth projected at around 3.5% in 2025 and 2026, supported by strong internal demand and the expected absorption of EU recovery funds.
This is a little bit pessimistic. Arguably, this will be more or less like 4% year on year.
The IMF is also fully on board with the National Bank of Poland's hawkish stance to date, calling it appropriate. Where we do see some convergence, however, is in terms of the Polish government's fiscal plans, which aim to bring the overall debt below 60% of GDP, in line with the EU's excess deficit procedure.
The core of their message is, well, you set some goal, but there's problem with commitment. So your tools doesn't sum up. You need to do something more. You need to propose more fiscal adjustments.
According to the IMF's calculations, the Polish structural plan looks more like this: debt stabilizing at around 65% of GDP and interest payments climbing to 2.6. And then we get to this. There's a clear link between the inflows of EU funds and gross capital investment in Poland. As these inflows taper off after 2026, something will have to fill the gap to keep growth at desired levels. Finally, Poland is reaching what's called the productivity frontier. It'll now have to transition from technology adoption to innovation. And for the time being, however, Poland's research and development spending relative to its peers is feeble, to say the least.
And today we're going to take a look at a more detailed report for Poland that has been released by the IMF following the staff consultation in the latter part of 2024. The outlook is steady with clear recommendations. So on the bottom line, we'll have the opportunity to get into the nitty-gritty details. So stay tuned. Beefing up transmission infrastructure and sourcing more LNG from across the Atlantic have been flagged as potential solutions to halt skyrocketing European energy prices. Finance ministers from across the EU found common ground on this electricity debacle and other issues impacting the euro after talks in the Belgian capital. EU correspondent Angela Skujins reports.
Finance ministers from across the EU descended on Brussels today to meet at a finance and economic affairs meeting. This is the first to be overseen by Poland's finance minister, Andrzej Domanski, and energy was at the top of that very stacked ballot, with tackling skyrocketing energy prices the major focus of today's meeting. Poland's finance minister said that after hours of discussion, consensus had been reached. Beefing up energy infrastructure was one solution to the crisis. Here is what he had to say.
Ministers agreed that we need to further integrate the energy market, reduce regulatory burdens, especially by shortening the permitting procedures, and accelerate investments in interconnections and grids. This is, I believe, a very good step forward.
Poland's finance minister also told reporters at a press conference after the meeting that he had spoken to the European Central Bank President, Christine Lagarde, and assured her that he would pursue the digital euro as part of Poland's presidency. This is despite Poland not being part of the Eurozone. He was pressed yesterday by TVP World whether this was on the cards for Warsaw, and he said that this was not part of the Polish presidency's agenda. Now, another undercurrent of today's meeting is how EU finance ministers can find consensus and address an incoming US presidency by Donald Trump. Donald Trump was sworn into office last night at a star-spangled ceremony, and he has previously indicated that he was mulling slapping serious tariffs on the EU. He also announced that he would pull the US out of those Paris climate accords to, quote, drill, baby, drill. Now, when the European Commissioner tasked with the economics portfolio, Valdis Dombrovskis, when he was asked how the EU should respond to something like this, he said that the continent was actually better placed with its acquiring of its energy, as it could source more LNG from the US. But now, as that presidency is only in its infancy, we'll wait and see how that progresses. My name is Angela Skujins, reporting from Brussels for TVP World.
The number of foreign tourists using short-term rentals to book their stay in Poland has risen year-on-year by 12%, according to Eurostat data. This puts the country in second place, only to Croatia in Central and Eastern Europe.
This is in Dubrovnik, but apparently foreign tourists don't care. Data from Eurostat has shown that Poland performed very strongly in terms of the number of guest nights booked by foreign tourists via short-term rental platforms such as Booking.com in the first 3 quarters of 2024. Compared to other countries from the region, Poland came second only to Croatia, and Paweł was surprised.
Poland has a lot to offer: sea, mountains, lakes, forests. We also have a very good quality of service. There's no problem with English at many tourist sites. Guests from Italy and Spain visit Poland to flee scorching heat.
Krakow may have something to do with Poland's success streak. In 2023, it made it to the top 20 European cities in terms of guest nights at short-term rentals. As many as 5.7 million nights were spent in Krakow, nearly 53% of which by foreign tourists. But why the popularity?
Businesses from Krakow pushed for new flights connecting the city with the Middle East, among others. So now guests from the United Arab Emirates, Abu Dhabi and Dubai descend on Krakow en masse, and then often move on to the mountain resort of Zakopane. Right now, Krakow is serviced by more than 40 flights weekly from the Middle East, each carrying 200 passengers.
To be fair, Krakow was bested by Warsaw and other regional capitals like Prague, Vienna and Budapest. But still, there is room for new milestones. Although Eurostat data for the last quarter of 2024 is still pending, Poland's performance in terms of nights spent at short-term rentals neared the 2023 mark already by the third quarter of 2024. In the sunny month of August 2024 alone, Poland came 5th in Eurostat's data, improving its month-on-month performance by as much as 27%.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.